Hello to all traders and welcome to this month's engagement of the NFP. Thank you for joining me. We'll just go through a couple of disclaimers as usual before we get right into the charts and where we're going for this month's predictability of the NFP numbers. It's been quite a crazy month, really. We've had the Fed's interest rate decision once again being at 5.5%, not really giving us too many signals on where they're going to go to next. But before, like I said, we get into anything, let's just go for the quick disclaimer of foreign exchange trading in CFDs can be highly speculative and may result in losses as well as profits. Foreign exchange derivative trading is not suitable for everyone, or the risk capital should be applied. Very important there. This webinar is provided for information purposes only, and no information contained herein constitutes solicitation or the purpose of purchase or sale of any commodity, security or investment, nor should serve the basis of any investment decision. All Bex Limited does not guarantee the accuracy or completeness of any information or analysis supplied. So just don't forget, this is my analyst, and the chat screen is open if you would like to add any of your thoughts on where you think the market will be going. Where is the dollar going for the next 6 months as we head into the second half of the year shortly? And also, where do you think the Fed is going to go as well? I'll be joined shortly by my special guest, Daniel, who will take us through a bit more in detail of where we're going to be heading, and we can ask him live questions as well. So let's just take a quick recap. As I said, I always like to just have a quick look at the couple of slides before we get into the charts. And as I said, unemployment rate ticked up to 3.8%, which is quite worrying. It was holding around 3.5, 3.6%, now ticking up a little bit dangerously to 3.8%, heading to 4%, which is a little bit precarious. Non-farm payrolls did surprise last month at 303,000. It was supposed to be 200,000 new jobs being added, but we had over 100,000 extra. So that was a very, very good uptick in the US economy there. And obviously, with that being said, the Fed might hold its rates even further if they think that the economy is getting back on track, because guess what? Inflation is still above 3%, which we'll look at shortly. But let's just take a quick chart movement of look on the chart movement, sorry, of the NFP figures. So pretty much for the last year, we've been floating around 200,000 to 300,000 new jobs being added. This 303,000 though that we had last time around was the highest in 10 months. So that was quite significant. As you can see here, we got to July, August, September, October, November last year. We were a little bit subdued below 200,000 new jobs being added. But since then, we are adding every time over 250,000. So it is looking like it is a good jobs number. So that's quite progressive as well. So just the last slide before we get onto the chart. So the Fed stuck to their guns. They kept their rate at the highest level in more than 22 years at 5.5%. And it looks, as you can see here, the last few readings is pretty much flatlined since we had a pause in the rate hike. So we have hit a terminal rate now. We're just waiting for the first rate cut. Will it happen this year? Will we get one or two before the end of the year? We'll have to wait and see, but it is looking likely that the Fed is becoming under more pressure to really start thinking and giving signals and delivering on its promise that it will start cutting rates. But as you can see here, annual inflation, if I just take you to this graph at the bottom of the screen here, annual inflation jumped to 3.5% in March. So we were hitting 3%. And to be honest, when we hit 3% pretty much this time last year, after coming from 9.1% in the middle of 2022 back down to 3%, I believed it probably would keep slowly getting to 2%. But since then, as you can see here, we ticked up to 3.7%. Then we had a move back down, then another move to 3.4, then a move back down to 3.1, and now it's slowly creeping back up to 3.5%. So it's just a bit worrying for the Fed. Are they going to start thinking about when they're going to cut rates this year or possibly into next year? And also, have we avoided a recession? As I said, our special guest speaker, Daniel, will be joining us shortly. So we'll be able to see what he thinks and where he thinks the market will be going as well. So I'll just share my screen for the MetaTrader platform that we have. This is my Orbex demo account, and as you can see here, I've just picked a basket of the popular pairs that will most probably start moving pretty convincingly. So let's just take a look at the euro dollar first of all. And if I just pull this back to a daily chart, now the euro dollar was pretty much collapsing for most of the year. If we go back to where we started the year, this is on the 28th of December. So from the new year, basically, we dropped just over 400 pips. We had a move higher, back up to 250 pips, but since then, quite a big collapse of almost another 400 pips. So it gives us the impetus that the dollar is strong. It is back on its feet now, and it's looking likely that this strong American economy will keep pushing until the end of the year. Now, when we had, if we go back to the weekly chart, when we had the Fed continuously adding its rate by 75 basis points every time, we saw this progressive nature all the way up to the fact that we saw parity. We had a break at the 1 area, but since then, when the Fed has been slowing down and stopped cutting rates for so long and progressively adding on its value up to 5.5%, we've been having this very choppy nature. But price action is going towards the 108 handle, hovering around 110 for a while. So let's go back to the 1 hour chart, because what we're looking at in this NFP session, well, the euro has been progressing quite significantly, but as you can see here, we now are coming roughly to a bit of a double top here. And when we do get to these particular signals, it's like the news is waiting to happen. We are waiting to see if the NFP is going to start having a big effect. These big fundamental news events are very, very key in the big drivers of the economy. Now, we saw what the Fed did to the euro dollar pair, and obviously to most of the other pairs here. This is when they released their news event at 9 o'clock GMT plus 3, which was 9 a.m. 3:30 p.m. in the American session. As you can see here, it fluctuated by roughly about 50 pips before price action got back on track. So this is a big indication that the move was pretty much priced in. 50 pips isn't too much of a big move when a big fundamental news event like the Fed's interest rate decision has been announced, but there has been more and more of a big progression since then. If we look on cable as well, pretty much the same story. We'll just zoom in a little bit on the hourly chart. As you can see here, big move in the market, roughly about 50, 60 pips, 57, 58 pips to be precise. And then we had this complete reversal before the market got back on track, consolidation before another move higher. But as you can see here, let me just pull this chart out. So as you can see here, pretty much like the euro dollar as well, it's moving in the same tandem. We are hitting this kind of double top now. Let me just pull these two charts together so we can see them a bit clearly, because the euro dollar pretty much always moves the same way as cable as well. It's not too different, even if we do get some big sterling news as well. As you can see, the Fed, we are moving up and down. And now, as you can see, pretty much the same pattern before another move higher. And now we're hitting a top like the next one as well. So this is what's happening. And this is where we're going to as well. Hi, Nora. We are waiting. Yes, we are live now. Please let me know if you can hear me, if everything's okay. We have just over 20 minutes to go for the NFP data. Hope you can hear me okay. Please let me know if you have any problems with anything. As I said, we're live on YouTube at the moment. So if you have any questions, please let me know. So just a quick recap on cable then. A little bit like the euro dollar, we are seeing a bit of a double top happening now. So that could be heavy resistance. And then we're just seeing what's happening now. Hi, Nikhil, glad to have you back. Yes, gold, just looking on that next. And what can we say about gold and the dollar yen we'll be looking at shortly, coming along now. Thank you for your messages. As I say, keep me posted on what you're trading recently and on what we're looking at as well. So bring this gold back to the daily chart. And as you can see here, we had two very nice double tops here. And, we had a little bit of a false break after the recent record high. But since then, as you can see, a big collapse, a big sell-off on gold. And a lot of traders and analysts are hoping that the 2300 handle is going to be held. This is a big psychological handle for a lot of traders, because as you can see here, we had a bit of a couple dips, a double dip past the 2300, but straight away price action was indecisive, moved higher thanks to the Fed, and now we're just kind of consolidating along this particular level here. So is it a sell or a buy? Let's get into that shortly. We're just going to check the charts, and then we'll see when the NFP data comes. We'll see if we can have a clear signal if we can buy or sell. Well, you know, if we do get progressive numbers on the NFP, then the dollar should be strong, which will make the gold weak, and vice versa as well. If we get a bad reading on the NFP, we could see a big move to the upside for gold. So let's wait to see for the next level. But keep your questions coming. Thank you for joining me, as I said. So gold at the moment, let's go, as I said, let's just zoom in. At the moment, as I said, just consolidating along this 2300 handle. It's looking likely this is becoming a firm support and resistance in the near term. We had this kind of breakthrough before. We had another bounce here, and then another bounce along these particular lines here in the last few trading sessions. So this is what we're looking at. And actually, this is just yesterday in the trading session, we had very, very heavy support at 2300. And even then that we broke 2300 and confirmed with this bearish candle of roughly about $7, we only had roughly about $1 below the 2300 before we started coming higher as well. So this is very, very important for gold, because if we do get a confirmation break, then gold can really start falling quite considerably. I mean, if we look now how far gold has come due to the geopolitical tensions from last August, we are now seeing price action moving even further. So, you know, since last October, when the recent conflict began, we've had over $600 being added to the yellow metal status. But since then, since we hit this record high, we've had just over $100 being wiped off the yellow metal. So it is actually very precarious at the moment, very risky at the moment, due to the big fundamental news events really moving the market as well. So keep your questions coming. Let me know what you're trading on. So thank you for your comments. I'm just going to look on gold and dollar yen. Yes, dollar yen was the next on the list. So as you can see here, dollar yen really progressively moving lower. You know, we've had the Bank of Japan that has really started to move the yen. It was one of the only central banks that didn't really move its rates at all. But in the last couple of readings, we've had two movements back into positive territory after being on minus 0.1 for so long, which was this big move here. And then since the Fed had got involved on Wednesday with their movement as well, we have seen pretty much a massive collapse on the yen, just over 400 pips, quite significant, quite remarkable actually. So if we go back to the daily chart, we were on record highs for the dollar yen actually, but since then, as you can see, such a big collapse on the pair, moving over 700 pips. I mean, that's quite astonishing in just a few sessions. You know, such a big sell-off, such a big correction in the market. A lot of traders were wondering when the correction was going to be after such a big movement in the market to the upside. As you can see here, if you put it on the 4-hour chart, it gives a better reading because we had such a big move. But since then, you know, price action's fallen, sell-offs have happened, even on the US indices as well, which we will look at shortly, because I want to bring up the Dow as well. So the Dow, we've got on the daily chart. So like the S&P and the NASDAQ, we hit record highs on all three indices, and indices were progressing after the earnings report, obviously after sustained growth in the economy, and also most significantly avoiding a recession possibly this year. Okay, we haven't even got to the first half of the year, but we are looking likely that price action will keep on going through. So Juan Galetho, thank you for your comment. Are we buying or selling dollar yen? It's looking likely price action is holding at the moment. We could see slight consolidation after such a big move in the market. As you can see here, prices are just trying to get a bit of ground here. As you can see, roughly about the 152.80, 152.82 area. So because we are now consolidating, we could see more of this kind of sideways pattern that keep on the straight and narrow for the dollar yen. Will it recoup all of its losses? 700 pips? Probably not in today's session, that's for sure. But obviously, lots of news to come. So just over 15 minutes to go. So keep your questions coming. So Nora said dollar yen is going to sell. Thank you for that prediction, Nora. We'll have to look out for that. So let's just put a, I'm going to say this support here of 152.80. If that gets broken, then we can pretty much start looking for about 50, 60 pips to the downside, which is a bit of a confluence with the 152 round figure. So this, let's highlight that as well for the dollar yen. Very, very nice levels there. If we do have a collapse on the dollar yen, more of a sell-off, then as you can see here, we are looking likely, if we look at each candlestick on the 4-hour chart, this is 60 pips. And again, this is 60 to 70 pips. So we're hitting pretty much 60 to 70 pip drops. So this wouldn't really be a big surprise if we did drop another 60, 70 pips to the 152 area, and we'll see if that's going to be having a big support as well. So a quick look on the Dow before we go back on the euro dollar. Thank you for your comments. Buy or sell euro dollar, we're going to check that back in a second. And dollar is strong, so we can buy dollar yen, I think so. Okay, let's see if that prediction holds true. So Daniel has just joined me, so it's time to put my headphones on, and I'll just let him into the room. Hi, Daniel, can you hear me?
Yeah, seems to be working.
Great, great. And the camera's working because we can see your face, so it's even
better. I made sure it was fully charged and everything this time.
Exactly. So I've just been taking our guests through most of the charts here, and it's looking likely that, not likely, but the dollar has been coming back in the last few sessions because we had such a big spike on gold in the last couple of weeks.
Exactly.
And now we're just having a bit of a role reversal, and the dollar's on its way back, especially after the Fed held its interest rate again, which was kind of predictable, wasn't it? I don't think they were going to throw up any surprises at the moment.
Yeah, there's like 98.6% of the chances that it would do exactly what it did. So hardly, there's like maybe 1.4% of the people were surprised.
Yeah, exactly.
Not very much surprise there.
Exactly. So, I mean, with that being said, we're seeing indices, the US indices, kind of drop off slightly, and a few companies like Apple have had a little bit of a shock when it comes to earnings season. Is this really affected the indices because of that reason, or are we just seeing a slight correction because we couldn't keep topping record high after record high, could we? Or could we?
Well, in theory, the thing is, it kind of like coincides. You could say both, blame both for it, really, because earnings haven't been all that good. Well, I mean, they've been kind of mixed, and so you don't. It wasn't like was the earning not the last earnings season, but the earnings season prior to that. You'd get like a whole bunch of data of companies that are doing really well, and that would help lift up the index. You get sort of like Microsoft does very well, then Apple doesn't do very well, Google does very well, Tesla doesn't do very well, and so it's kind of a mixed bag. And so if you're not getting a clear signal from all the companies doing well, and then the Fed is sort of like, well, we're not going to, give any easing really soon, then it keeps the pressure on the indices, and also that helps the dollar because it keeps up the yields on the debt. So I think that's really right now it's the yields are the combination of the yields and also disappointment, a little bit of disappointment with the earnings. We no longer have the Magnificent Seven. It's now maybe like the Fab Four or something like that.
Yeah, that's true.
I think at least two of them are negative so far this year.
Yeah, that's true. That's true. So, I mean, with regards to a soft landing for the American economy, I think, is it safe to say we could avoid a recession for the rest of the year? I mean, if the Fed is going to hold its rates until it sees something very progressive that it can start cutting rates, I think they're going to keep rates higher for longer, aren't they? Until they're very, very sure.
Yeah, that seems seems like they're gonna go through with what they said they were going to do.
Yeah,
It's like, as we were talking about at the beginning of the year, like the Fed said is only going to cut two or three times. The market was saying he's going to cut six times. Well, who are you going to believe, the Fed or the market, when it
exactly.
comes to what the Fed is going to do? And so now the market's come around to sort of agreeing with the Fed. They're actually only going to get around to two or three rate cuts, if that many, maybe only one, because the inflation is coming back up, which is kind of to be expected considering how much deficit spending the federal government is doing. It's an election year. Of course, there's going to be deficit spending during the election year, so that's going to keep the upward pressure on inflation. And the thing is that also would theoretically reduce the chances of a recession, but you could still have a recession. The thing is, a lot of the predictions for the recessions that everyone was talking about last year was on the basis of the yield curve inversion. The thing
Mhm.
about it, because that is accurately, every time the yield curve has inverted since 1960s, there's been a recession within 2 years. Well, we still haven't gone through that 2-year period yet, so we can't 100% say, well, okay, the yield curve inversion failed. And the other
Mhm.
thing about it is that every time before the recession starts, or before you get the big market crash, the yield curve uninverts, and usually that's preceded or around the time you get the Fed does its first rate cut. So usually you get a rate cut by the Fed, and then you see the market go down maybe a couple months later. So the fact that the Fed would cut would be, yes, generally positive, because it would help the help easing, but also it would fit in the pattern that we've had for the last 1960, that'd be 60 years, in which you get a yield curve inversion, de-inversion, Fed cut, and then you get a recession with the corresponding market crash. So I wouldn't say we're entirely out of the woods yet, going by history.
Yeah.
But then, of course, the thing that we always say is that you can't go by history to predict the future. So,
Well, yeah, and there's the old saying that history can repeat itself. So
yeah.
it's something to look at. We have one of our guests asking just to have a quick look at the Nasdaq. I wanted
Mm,
just to pick your brains a little bit because I've got the Nasdaq on the screen at the moment, and on the daily chart, as we said before, we hit record high after record high, and even when the Trump administration was in, like, well, 4 or 5 years ago now, we were hitting record high after record high on most of the indices as well.
yeah.
It has been so progressive over the last few years. And the only problem is when we get a correction, it seems to be quite a harsh correction because everyone's
Yeah.
anticipating the correction. It's kind of not coming. And it's like, okay, it did, and then it does come. And then all of a sudden it's like, oh, yeah, there's a correction.
Yeah.
So, with that being said, as I said before, do you think it's mainly the US economy not knowing where it's going at the moment until the Fed gives the first signal? Are we waiting for the election to happen? Because that's not far away if you think about it, only like
Yeah.
5 months away.
Yeah,
So
those are really good points. Exactly. Especially the thing about how you keep the successive of new record highs, and then you get the big pullback. One of the things that the Nasdaq in particular has had is has this really high weighting of tech stocks.
yeah,
So the well, I guess they're no longer magnificent, but the seven have about half of the weighting, or about half of the index is just these seven stocks. So if they're doing good, then great, they're going to keep going up. But they're all really highly dependent on AI, which could be kind of a bubble. And so you might see just a few stocks can get overextended, and then you will then have a pretty big, the correction will be much bigger than if you had a broader market. So the thing would be is, well, one, the tech stocks aren't doing so well, but that could mean that they're, the big tech stocks are not doing so well. That means there could be more space for the other tech stocks to, you know, catch up, and that would broaden out the market, and then it would be able to solidify, and then we might not be so worried about having such a strong correction. But given how much, like, I think it was 63% of the total returns of the Nasdaq last year was due to just those seven stocks.
yeah.
So if something happens in AI, or or the market just gets spooked, you can get these like relatively fast large corrections, because most of these stocks are trading at PE ratios well above the norm. I mean, the S&P 500 is trading at, I think it's 27 was the last time I checked,
Mhm.
and the normal is 15. So it's almost nearly double where it's supposed to be, which means if there's a correction, it would go back down towards the 15, and NASDAQ is even higher. So all it does, it would just need a slight correction in the valuation, but that would be a kind of significantly larger mover, particularly in the Nasdaq, because it's so highly undiversified. Essentially, this is the same
Yes,
thing when you manage your yeah.
exactly. It's very tech heavy, isn't it? And we've had in the last 6 months, well, since the beginning of the year, such a progression on tech stocks that a lot of traders were thinking, is there going to be this kind of fallout with AI stocks? Because it might not be the same basket as the dot-com bubble over 20 years ago, but at the same time, AI is bound to slow down at some point, isn't it? We can't keep going.
Yeah, can't keep going at that
with
rate.
these new, if you get a new headset, it's a wireless headset, and then it plays music for you, and then it might glow in the dark, and it can keep progressing. But obviously, at some point, they're going to run out of ideas. And yeah, like you said, because the Nasdaq is tech heavy, we could see a bit of a correction in maybe the next earnings season when the next quarter might not be so progressive.
Yeah, it seems to be kind of the particularly there's a sort of there's high expectations for this quarter and they're not being met, and so they're saying, okay, well, it's going to be the next quarter. Next quarter is going to get the bump, and eventually they'll sort of like, hey, you know what? There's been stocks that have like grown at 300%. Nvidia has been up like 300%. You can't keep increasing your sales at 300% forever. At some point, you're going to like. Growing at 20% sales is pretty fine and normal for a normal company. But if your PE ratio, like Palantir's PE ratio is at 290, that means they're gonna have to have 290 years of their current income in order to justify their stock price. That's not really sustainable. It should be down like to 10 to 15 years. So they're either going to have to get their sales and income is going to have to go up by 300% for the next 10 years, or something is going to, they're going to have some kind of correction. Not 10 years. It's going to have to go up. Well, it has to go up for a substantial amount of time to catch up to where the stock price. And so if the stock price keeps rising at the same rate and their sales and income isn't keeping up, then eventually you're going to have something's going to happen.
Exactly, something's got to give at some point. Definitely right. And I mean, we were just looking on the euro dollar chart as well. With it being so progressive in the last few trading sessions, are we bound to see the dollar being so progressive again that we might see parity? I mean, we were trading roughly about 108. I mean, is this a realistic? I mean, okay, it's 700 to 800 pips, but I mean, it's not out of the question if we do get progressive dollar data and signs from the Fed.
It's not. It's quite within the realm of possibilities.
Yes, exactly.
Yeah. It really also depends on sort of the timing, because you have inflation in Europe coming down a little bit faster than in the United States. So that would presumably put the EU on, or I mean the ECB on course to cut rates faster than the Fed. And so that's kind of already priced in. But if the Fed were to keep rates higher for progressively longer, and then the ECB starts cutting, and then they cut again, then there would be the differential in interest rates would probably line up to going back to where it was when it dropped down to parity. It might not go all the way down to 0.8 where it went down before, because there's a really big gap there. I think it was up to 4 percentage point gap, because the Fed had already hiked several times and the ECB hadn't gotten around to doing it. And so then the gap has shrunk. So the question is if the gap goes back to 3 or 4% and percentage points, then you could presumably get close to or go back down to parity. So it's also a matter of, it's not just what the ECB and the Fed is going to do, it's also what time they're going to do it, when they're going to do it.
Exactly. And just 1 minute to go before the NFP is announced, just wanted to pick your brains on the Bank of Japan, that they finally hiked, after all these years being in negative territory for so long. What are your thoughts on that?
Oh, well, they're in a really tight spot, because they're so connected with the notion of having low interest rates for an extended period of time. It's really hard for the Bank of Japan to start raising rates, because they'd have the same thing that happened last year with in the United States, with the Fed increased rates and they had several banks collapse. In Japan, it's significantly worse, so they can't raise rates all that fast. But you had their currency has been depreciating significantly, and that's leading to higher inflation. So they have to raise rates. So how are they going to split that is going to be really interesting to watch. much.
Yeah, something had to give with them as well, I guess.
Mm,
Okay, thanks, Daniel. Just waiting for the numbers to come in now. Oh, unemployment rate has ticked up by 0.1% to 3.9. Non-farm payrolls 175,000 only.
ooh,
So,
that's
uh,
below the expectation, like
yes,
the lowest of the expectations.
exactly. The expectation was roughly around 240,000. So we've come in really, really low here. So we could be
Yeah.
seeing a bit of a wipeout across the board for the dollar, which we are doing at the moment. Um, and yes, that seems to be what's happening at the moment. Euro dollar moving higher, 40 to 50 pips, same on cable as well. Gold really jumping over $20 at the moment. So everything out of favor for the dollar and
Oh
in
yeah, I guess
favor
everyone's
for,
expecting pulling forward the Fed, that they're gonna cut sooner than
yes, it
expected
could be
before.
now. Yes. So it is, when we get a bit of a knockback on the numbers for the NFP, we usually get more of a move out of favor for the dollar. But the NASDAQ is flying. I guess the indices are probably hoping a little bit more stimulus injected into the US economy then if we're getting bad jobs numbers, maybe.
Yep, yeah, I'm pretty sure that the indices would probably be the ones who like that the most.
Yes.
The yen might be kind of interesting because of their intervention recently. That would
Yes.
definitely help the case for the BOJ, or well, the Japanese government. So that should be pretty. Well, the move has been going down, so I guess it's going to keep going that way.
Yes, exactly. Um, it's looking likely that we could be seeing a bit more of a fallout for the dollar. But what do you think about the unemployment rate ticking up a bit higher to close to 4% now? I mean, 3.9%. I think a few readings ago it was falling a little bit towards the mid 3% range, but now we're
Yeah.
kind of ticking up, aren't we?
Yeah, the thing is, the structural unemployment rate is somewhere around 4, maybe 4.1, 4.2, and so if it goes above that level, the thought is that it's going to really push down the average earnings, which is the thing that the Fed is sort of waiting on, is because you have the people's salaries are going up faster than inflation, which means that they have
Yeah.
more disposable income and so on. And so that's happening because you have a tight market. According to the theory, is that you have a tight labor market. So if
Mhm.
the unemployment rate gets above 4, 4.2, 4.3, it's not like an exact science exactly where the ah, the level is. I just had it in my head. And so once it crosses that, I mean, so we can't go and say it's exactly at 2.4 and it goes up to 2.3, then the whole thing changes, but it's
Yeah.
somewhere around there, right? So we don't know where structural, that's the word I'm trying to say, structural unemployment is. We don't know where exactly it is, but we know it's somewhere around there. So the thing is, once it goes above that level, then you could probably see the average earnings drop down below the inflation rate, and then, well, you'd have, that wouldn't be good for the workers, but it
Mhm.
would be good for bringing down inflation, which is what the Fed is really worried about. And so if you get that situation, then the Fed, which is also worried about the potential problems to the economy not growing fast enough, would then be able to cut. And they apparently do want to cut quite as well, as much as possible.
Yeah.
So if you get that situation, then you could see the Fed cutting maybe 3 or 4 times, and then the original assessment of the market might actually come out to be true. But
Yeah.
we're still a little bit far away from that.
Yeah, I was going to say, if the Fed do begin the first cut, let's say, do you think it's going to be a domino effect then? You think once the first one's been done, it won't be long after we see another, then another, then another? Or do you think there's going
Yeah,
to be a cut
this
and then a year later there's another cut?
yeah, the question is whether or not you get the market drop afterwards. That sort
Exactly, yeah. I
So
guess
if you
that's
get,
right.
yes, the thing is the Fed would like to cut maybe twice this year and then hold maybe or after third or the fourth cut.
Yeah.
I'm not exactly sure where they see the neutral rate is, but they do currently think it's restrictive, which means that they want to bring it back down. So but that would suppose that there is no recession. If there is a recession, if you have the market
Mm.
going down, say in September, which is, there's a history of the market dropping significantly in September, if they cut, for example, in, well, they could cut in June, but maybe not likely. So they cut in August. You get the market go down in June, and then they would start cutting really drastically right after that. So
Yeah.
you have, there's basically two roads. It's not like a middle road in there. You have either they're going to drastically cut, or they're going to try and keep it at probably, you know what's it, 5%. They'll probably bring it down maybe to 4 at the most over the course of a year, maybe.
Yeah.
That's a guess.
Yeah, exactly. And just before you guys want to pick your brains on the fact that inflation jumped to 3.5%, is this an indication that, you know, we could see inflation start picking up even further? It's not really, even though we got down to 3% and everyone was like, oh, okay, yeah, it's gone from 9.1%, we went down to 3%. Surely it's going to get down to 2% soon. It doesn't seem to be the case, does it? It seems to be, you know, they call it sticky inflation, but it really is being persistent, isn't it?
Yeah, that's part of the well, if we go back to history, they had this really big problem with high inflation in the late 70s, early 80s, which is when the whole Volcker thing that became kind of famous, and they
Yes.
raised rates up to 15%. That the pattern of inflation going up, coming down, and then getting around to about and then staying down for a little bit, the Fed started cutting, and then the inflation went rocketing right back up to even higher than it was before. And
Wow.
that's when the Fed was forced to go up, to raise rates that much higher, because essentially the idea is that rates have to be above the inflation rate to bring the inflation down. And so if the inflation rate goes up to 9, then you have to raise the rates to 10. If it goes up to 14, you have to raise it up to 6 to
Yeah,
15, and so on. So
exactly.
there is a historic pattern that says that maybe in the course of the next few months, more than a couple, you'd get the bump back up in inflation, and then that would force the Fed uh, to raise rates, and that's another risk that could push the economy into recession. Because if the Fed comes around and says, "Hey, actually, you know, we're going to have to raise rates," that would be a serious shocker for everyone. And
It
we
will
also have
be,
to
yeah.
remember that the economy, the Q1 economy, didn't do so well, not as well as expected. And so now
Yeah.
you have a situation, the economy isn't doing so well, and you have higher inflation. That's a really uncomfortable position for anyone doing monetary policy.
It definitely is. So we don't envy the people on the FOMC panel, that's for sure.
Yeah. I only envy the salary. That's it.
That's it. Yeah, that's true. That's true. Okay, Daniel, that's great. Well, thanks for joining me again for the NFP. And
Thanks for the invite, as usual.
no problem at all. And yeah, have a great month ahead, and we'll see you on the next time around.
Yeah, cool. Take care.
Great. Thanks a lot again. Cheers.
All right.
All the best. Bye for now.
Bye.
Bye. So that was Daniel bringing his expertise to the market. Always good to get a second voice on what's going on in the market as well. So let's just take a look at what's been happening then since the NFP, 7 minutes now after the NFP has happened. So, you know, we did definitely break this previous double top. I mean, we were seeing this being tested roughly about the mid 107 area, now hitting 108. Will we get a confirmation above 108? Because it is a big psychological area here. We'll just point that out here, just roughly about here. That was when the big collapse happened, and we had quite a big sell-off in the middle of April. So that was when we dropped just over 270 pips to the downside. Since then, though, as you can see, a nice V-shaped recovery is taking place. But we probably will get a bit more of a correction, pretty much like this kind of move, before we have that V-shaped recovery back up to the top towards the 109 handle. So looking good for bulls in the euro dollar zone, having quite a weak dollar for this particular session. So let's just take a look at the other markets as well. Cable's probably moving in the same direction, roughly about 70 pips to the upside now. Yeah, just at the top of this spike here, 70 pips. Let's look on the 4-hour chart. So we've broken this particular previous double top here, as you can see. Now we're just going on, as I said, to when the market collapsed on the 10th of April. And on cable, it wiped off roughly almost over 400 pips. So quite a big move there. Let's get right on to gold. I know that a lot of traders are looking at gold at the moment. And wow, what a story that has been. So we've moved just over $25. It is retracing a little bit now, $15, but still quite a big move for bulls, especially the fact that we are holding above 2,300, which is quite very, very, very important, because if bulls can hold over to 2,300, then as you can see here, we could be looking for another push at this recent swing high at 23.25, and then, you know, another record high could be in the picture as well. So this is very, very apparent. Dollar yen now, wow, we did have a few people predicting where dollar yen was going to be, Nora and Wangeletho. We were looking at where dollar yen was going to go. I did say that we were moving down in 60 to 70 pip moves, and this has been no different. We have moved down roughly from 153 to 150, just over actually 100 pips now, and we have broken the 152 area just right now. So such a big move in the market is giving us consistently weak dollar movement, and that will probably continue for the near term as well. So quite a big move there. Keep your questions coming. As I said, we are coming to the latter stage of the webinar now, but I'd be happy to see what you're not only trading on now, but what you think to trade on for the next 6 months now that this NFP result has come in. Unemployment has got higher in America as well, and we could see the Fed hold on their rate decision cut for the next round. NASDAQ, wow, what a move to the upside. Let's see if we're hitting these record highs or going to these fresh highs, sorry. At the moment, it's going in the way that a lot of bulls want it to. So we've had this move to the upside, and then we've had a slight correction. But since then, as you can see on the daily chart, we're going to another move higher now, hitting a slight double top on the daily chart. Let's look on the hourly chart, though. It is looking likely that we have ignored the Fed's decision from a few days ago, and now we are moving quite nicely higher as well. So that's all the main markets covered. Let me know what you think, what you're trading on. I will be around for a bit longer to answer any questions that you may have. For now, we're going to close the presentation, close the webinar. So thank you very much for joining me. It's been a real pleasure to answer any of your questions, listen to what you're trading on. And as I said, I'll keep the chat open for a little bit longer. So let me know if you have any questions, and then we'll see where the market's going to go for the rest of today's session. So it's been a pleasure, like I said, as always, and we'll speak again next time around. Bye for now.